So I'm just going to talk a little bit about conceptually what we've been seeing in the markets over the last month, how that's been feeding through into our portfolios, and what we've been doing investment decision-wise. From our perspective, and when we get through to the numbers, we saw in January, obviously, we started the year with a concern over whether we were going to see the development of some form of World War III in the sort of brief exchange between the US and Iran, most of which seemed to occur in Iraq. That kind of feels like it happened a long time ago, given the recent focus that we've seen across the world, really, on the coronavirus and how that's been developing predominantly inside of China. And I think we read in the news today that we've had our third case in the UK confirmed now. We've had a lot of debate on the investment team in terms of the validity of the numbers. There's some concerns and questions over whether the number of confirmed cases in China is substantially higher than what has been widely reported in global media. The other sort of aspect that we've been looking at is, is it fair to compare this coronavirus outbreak to the SARS virus that we saw back in 2003, both from a number of cases worldwide, number of deaths that's caused, number of countries it spread to, but also is it a valid comparison given the difference in the size of China as part of the global markets and global economies. So we've been looking at this from quite a few different perspectives. The good news from us on a performance perspective is that we saw in all of our multi-asset models positive performance through the year, which if we click onto the next slide, we'll get that back with the power. So yeah, for our dollars, euros and sterling across all three of the multi-asset mandates, we had positive numbers. It's slightly tricky when you get, for us and for the S&P 500, negative markets for the month for our conservative portfolios, given seeing some of the movements on the fixed income side, meant that we actually had some quite strong performance numbers coming through. We're looking at performance compared to two different metrics: the target return, which is our absolute return number, so the CPI plus the appropriate spread, and the ARC private client index. So we're looking at the peer group, which is tens of thousands of private client accounts. Obviously, we can see a little bit of underperformance in the euro growth versus the private client index, but we've got a lot of conservative and balanced mandates. So for the sterling conservative, seeing that sort of up between 2 to 2.4% versus the private client index of up of 0.1. That's some sort of quite strong outperformance, and a lot of that comes from some of the duration positioning that we had in the portfolios, which Jeff is probably going to talk a little bit more about. I just wanted to make the comment that it's been a little bit volatile in January. Although the S&P 500 closed the month slightly negative, we have seen some bit more significant down days than we saw in a lot in the last part of 2019. And some of the bigger movers have been on the commodities side. We are quite early on in the outbreak of the coronavirus, and one of the focal points that we've been having is, irrespective of number of confirmed cases, number of suspected cases, the impact on Chinese GDP growth, Chinese consumer spending, but most importantly from a supply side perspective in terms of the number of goods that are made by China and supplied to other parts of the world. This is something that is going to rumble through into Q1 earnings, which we'll be starting to see in sort of April, May time. So even though the news and headlines is going to be on deaths and number of confirmed cases, this is not something that's going to move out of the limelight in the near future, even though some of the headlines may do. So just in terms of focusing a little bit more on that point, we can see bottom right with the Hang Seng when we had a sort of a slightly extended closed period, but both markets have started to rally back up and continue a little bit higher. There was some unsubstantiated reports that one of the Chinese universities had developed some sort of potential cure to the disease, which has been received very positively. We are still seeing more cases on a day-by-day basis, although the growth rate seems to have stabilized somewhat. But I think from our side, we're still in very much a wait and see mode. One of the questions that we have been looking at is the longer this persists in terms of people working from home, people on sort of enforced staycations, vacations, unpaid leave, but it's bigger than that in the sense of people, tourists not able to go out, people not visiting the country, but also Chinese people not coming to Europe. And that's going to then start feeding through to hotels, restaurants, and retail outlets over here. So it is not a Chinese issue, irrespective of number of confirmed cases abroad. This is going to impact companies globally and economies globally. I've seen 1 to 1.5% of global GDP growth being knocked off because of this, and that's as it currently stands. So it could be a little larger than that. So I think from our side, it's headline numbers and figures are one thing, but it's going to be the kick-through impact on the actual economy that we're a little bit more concerned about for the time being. And just in terms of sort of plotting coronavirus versus SARS, I mean, SARS had a 2.5 month downturn and then a sort of a longer sustained rally on the way up. We've not really seen much of a turn down in the coronavirus. There's been a couple of 1-2% down days, but a lot of it has been fairly neutral, and any positive news has been very quickly pounced on and pushing stock markets higher. That's led to the same sort of issues on the equity side in terms of additional stimulus being pumped in by central banks and some of the valuation numbers being a little bit more stretched, but we'll come back to that in the equities section. Just to sort of skip very briefly through this, I mean, commodities was the main drag given the commodities consumer that China is on a global scale, and EM equities being dominated by Chinese equities. So it's not much of a surprise to see both commodities and EM equities taking quite a pullback on a year-to-date or month-to-date basis, given that it's the same. I'm just going to pass across to Jeff, who's going to start talking on the fixed income side, and then we'll come back to equity shortly.
Thanks, Simon. So, as Simon mentioned, it was a very strong start to the year with phase 1 of the US-China trade deal being signed and completed. But the market direction quickly took a turn and reversed, with investors becoming more cautious about the impact of coronavirus. But that said, returns were still positive across the board for all fixed income classes. And that was driven mostly by activity in rates given the flight to safety. Now, sterling also outperformed all other currencies, and that's with the gilt market following a set of underwhelming Christmas retail numbers. But at the same time, in Mark Carney's final MPC meeting of the year, he also provided some dovish forward guidance where he revised the growth projections for the UK downwards and also pushed back inflation expectations back to the end of 2021. And rhetoric for a cut by the Bank of England also surfaced all through January, but we held our ground and we took the view that an insurance cut wouldn't be warranted. And that's on the back of the strength of the labour market in the UK, and also through flash PMI numbers and also through surveys from the CBI, we saw a return of manufacturing and business optimism in the UK on increased clarity over Brexit. Second, you'll notice is that government bonds outperformed risk assets mostly due to the coronavirus fears again, and developed markets also outperformed emerging markets given the regions where coronavirus was expected to spread. And for our client accounts, we actually captured this rally in US Treasuries and also in UK gilts. We held off on executing our second tranche of Euro high yield until we see more clarity over the impact on corporate earnings from coronavirus. And just digging a little deeper into how we made money in January on the US curve. At the end of December, 30-year was trading at 2.4% yield. By the end of January, in that 30-day space, we were at 2%. And some of the events that drove that yield compression include tensions between Iran and US, which Simon has mentioned, but markets were very quick to shrug that off. And through the space of January, the price of WTI actually fell by $10 per barrel, and it's trading close to 55 at the moment. Secondly, US manufacturing, we saw the first ISM number above 50, so that's in expansionary territory. And that's a surge based on what we saw as strength in new orders, and it's the first rebound in 6 months. But we're cautious towards seeing that single data point as a trend, because we've both got Boeing, they've suspended production of their troubled 737 MAX jetliner, and it's still uncertain when they will actually make deliveries and offset some of their inventory that they currently hold. And we're still unsure of the impact that coronavirus will have on global supply chains and how it will actually feed into US manufacturers. As an aside, after months of a normal curve, we also saw an inversion at the front end. So we can actually make more holding 6-month T-bills compared to holding 3-year paper. And in our positioning, we're now taking profit on our 30-year position and adjusting our duration to be closer to 10 years. And then last year, we also made an investment in Euro high yield, and it still remains one of our top picks in the fixed income area. In terms of the impact of the virus, Euro-denominated credit, the sectors that are most exposed are retail, home and personal care, food and beverage, airlines, and also leisure. And in the Euro high yield index, these sectors make up for 20% on an aggregate basis of the total index. And the sub-segment of revenues that are exposed to the Greater China region is an even smaller sub-segment of that 12%. Now, the 3 names that we're most closely watching are Merlin, The Free, and Pizza Express. Merlin is the entertainment and theme park operator, and they've got 12 sites located in mainland China. And The Free is the duty-free operator, which has concessions in Chengdu and Shanghai Airport, and also in Hong Kong. Now, we've been provided with some respite with the announcement that the Chinese government would be pumping and injecting liquidity into the markets, particularly for local business that require that support. So we expect liquidity and working capital needs to be supported through any prolonged shutdown. So despite these 3 names being the worst, we haven't seen spreads gap out yet, and we don't expect so. So we still have comfort in holding Euro high yield, and we're still waiting for a better entry point. And then coming back to technicals, last month we spoke about Europe alone. But if we look at the supply and demand picture across the entire fixed income space, what's worth noting is the lack of supply when compared to a year ago. So we're expecting issuance to moderate compared to a record 2019. And this table shows gross issuance after redemptions and after purchases made by the central bank. And with the red numbers, the negative numbers, we're expecting far less supply available. There are 2 exceptions. One is UK gilts, where we expect the UK Treasury to fund any fiscal stimulus to support the Brexit environment through a glut of new borrowing. And then separately, we've already seen this trend, and we expect it to continue through the remainder of this year. And this is US corporates taking advantage of the much lower rate environment in Europe and issuing so-called reverse Yankee bonds. So we do expect an uptick in issuance in Euro high yield as well. But with $7 trillion of pension assets in Europe and an expected 30 billion in coupons that needs to be redeployed, we think this imbalance of supply and demand will actually drive spreads tighter. And just looking at January alone, looking at the supply picture, corporates have already tapped investors for a record 9 billion in new high yield issuance in Europe, and 26 billion in deals were actually priced in the US. So a lot of high yield companies have brought forward their refinancing needs exactly to avoid any bounce of market volatility, which is exactly what the type of environment we're currently in. So we have comfort in corporates and their liquidity needs. We don't think there'll be a liquidity pinch any time coming up. And we also actually saw that it was the energy and triple C space in the US which accounted for the bulk of the new issuance. So a lot of companies, for example, Chesapeake, have much better probability of actually being able to get through any upcoming maturities that they have. And then finally, as a recap of our positions, we're still overweight in US government bonds. Investment grade in US, we've moved to a neutral position. In the UK, we're still neutral, but with a favoring of the shorter end of the curve. Due to spread widening in US high yield, we've now moved from an underweight to a neutral position, but our top pick remains our overweight European high yield position, which we've expressed using an iShares ETF, given that it best represents the underlying benchmark and it has the lowest tracking error and also expense ratio. We've also had what we perceive as a non-event from the ECB when Lagarde came out and said that don't be complacent given the tepid growth expectations and muted inflation expectations for the year, but at the same time, watch out. But our base case remains the same in that the ECB won't make a move this year. With that, I'll give that back to Simon. There you go.
Thank you. One of our concerns, which sort of Jeff has highlighted a little bit on the fixed income side, is however much monetary stimulus central banks want to pump into markets, it can have a short-term positive equity impact, but it doesn't necessarily get consumers into the shops and buying goods. Consumers need low borrowing costs, higher confidence, higher real wages, and that's what's going to get them out, and that's what's going to drive company revenues, and that's what's going to support the markets on a fundamental basis. That's why when we're looking at the world through a valuation perspective, and we're starting to look at how the markets are trading, the US from our side is very, very overpriced, very rich, and that's why we're very firmly underweight on that front. It doesn't mean that there's not pockets of value in individual companies that we think look attractive and interesting. You know, we own a US stock in our portfolios, but it just means at an index level, it's not something that we wanted to take exposure to. The technicals and sentiment, which are going to be driven by short-term market movements, can change month to month. The macro picture is reasonably static, and it's reflective of an economic environment that's had 10 plus years of positive growth. And now we're at a point where we're, I said, waiting to see what the impact is from the coronavirus is going to be at a macro level. We've already seen short-term reactions in terms of the PBOC pumping liquidity in on the Chinese side, but at the same time, when you're imposing travel restrictions and trying to stop people from congregating in public places together, that is going to have a negative knock through on company earnings. That's, from our perspective, going to potentially lead to Q1, Q2 earnings being revised down. We show, let me skip on through. From an earnings expectations, you can start to see on the 2020 how we're seeing those expectations being revised down across the curve, irrespective of geography. The S&P's held up reasonably well, but that's also, if we skip back to a valuations perspective, right at the very top of where we could comfortably imagine it going. From here, we need to see corporate earnings increasing to justify the current valuation levels that we're sitting at, given that we're just a shade off 2 standard deviations away from the norm on the S&P 500 side. European markets look also stretched. FTSE 100 is the more reasonably priced of the 3. We're currently looking at entry points for FTSE 250 exposure across the models, with the idea that sort of post-Brexit, now that we have a little bit more certainty and we've kind of moved into the withdrawal process, then we still have companies that are exposed to the UK economy trying to negotiate round the companies that have a lot of currency exposure to try and take a little bit more exposure to direct UK rather than currency UK. On the S&P side, we do need to see some sort of correction to justify taking out exposure on that again, other than individual companies that we're looking at. So from a valuation side, valuations look quite stretched in Europe, very stretched in the US, a little bit more moderate and accessible in Europe. Emerging markets is something that we've stayed away from a direct ETF or tracker exposure, but we've been building up more interesting exposure through single stocks as part of the thematic plays. So we kind of stayed away from the index, and we think we're going to see a bit more volatility on that side as well. But I think one of our concerns is that there is going to be a little bit of a hangover effect as we're going to get into Q1 and then potentially Q2 earnings season, given some of the write-downs that we're already starting to see on the earnings expectations front. Currently going through Q4 earnings, although we've been positive from a surprise perspective, you know, the actual growth for Q4 top right-hand side is marginally negative, but it's not positive. We saw a lot of retailers reporting difficult Q4 seasons, both in the US, but also in the UK. But obviously energy has been one of the primary sufferers in that regards. And that's not something that looks like it's going to be changing anytime soon. So I think from that perspective, we're comfortable with our positioning being mostly out of the equity markets. Rally in the last couple of days is primarily on the back of unsubstantiated reports out of China. Valuation-wise, we do want to see markets correct a little lower before we start building up more exposure. Now, in terms of, just going to skip through some of these. In terms of building up more exposure, we're taking a two-pronged approach to that. So part of that will be core equity exposure. So we're looking at S&P 500 and potentially into the FTSE 250 as an alternative. And one of the other ways that we're currently composing what we're calling our shopping list is sitting more in the thematic ideas section. One of those, when we're looking at emerging market consumers, we've seen obviously quite a lot of volatility around stocks that have large exposure to that section of the marketplace. From our point of view, we're seeing that as a possibility to get some interesting entry points to increase our exposure to some of the stocks that we really like, that we felt were just priced a little bit too high. So we have, I will come back to it. These are some of the stocks that are in our portfolio versus some of the indices. So we've had from mail.ru, which was one that we added towards the end of last year, which contributed quite quickly from a performance perspective. We've seen that trade down a little bit, but all of our stocks have come off marginally. EA, which has been one of the strongest stocks that we've held in the portfolio, has also sold off. We did have the slightly humorous debate internally: if Chinese people are being asked to stay at home, does that mean that they're going to be playing more video games? Is that going to be more beneficial from a 10-cent earnings perspective? I think from our perspective, it's just more about public fear at the moment. It's difficult sitting in the West to get an accurate insight into different regions in China and seeing how that's been reflected there. We've seen various news snippets coming out. From our perspective, we are looking at how we can utilize this to build up exposure in stocks that we want. In terms of performance, when we're looking on now a 13-month basis, our strongest performing idea has been the emerging market consumer. That's significantly performed, obviously traded back a little bit with some of the recent news, but having been up north of 40% in 12 months, it's pulled back to be in that sort of just under 40% level, but outperforming the index by more than 20%. We're looking at building back up some exposure from a defensive perspective. So we're looking at some of the European car makers, particularly Peugeot and Volkswagen. From a forward earnings, they look quite cheap. They have obviously sold off a little bit with the rest of Europe, but from our perspective, this is giving us an interesting opportunity to buy dividend-paying solid companies. So we are looking to get into those within the portfolio. And that's the sort of a very, very quick whistle-stop tour around what we've been doing. Just in terms of some key takeaways. Number one, coronavirus isn't finished. I think we're going to get a lot more news over the coming weeks, but our main focus is going to be over the coming months and how much that is going to feed through to company valuations. Number two, the European high yield trade idea that Jeff mentioned, which we're continuing to sit on and looking for better points to increase exposure even further. and we have sort of mapped it out from a limited exposure to Chinese consumers in that regard. And on the stock side, we've been holding ground on our thematic ideas, and we're mainly looking for new entry points to continue to build up exposure. Before I turn it over to see if there's any questions, just a very small plug for our quarterly event on the 7th of April. We are going to be in this sort of format, but the idea is that it's going to be done over two and a half hours. The second hour and a half is going to be specifically focused on impact investing. So we're going to be tackling the issue of impact investment from a concept of what is it, through to how do we measure impact investing, looking at sustainability, in particular impact investing goals, and then trying to pull in a number of different participants from a panel discussion, both from investors, philanthropists, and also companies that are involved in the impact investment space. And some of them don't consider that they are. So we are going to be trying to look at some of the issues facing impact investment as an area within investment management, and it's one that our clients are increasingly focused and interested on, and trying to look at what are the issues and why is it different to ESG. So that's going to be sitting on the 7th of April. And then our next monthly update, where we're going to be more focused on the webinar side, is going to be on the 6th of March. Thank you very much for coming.